The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus podcast. I am fired up, guys. This is going to be worth its weight in gold, if I say so myself. Mr. Salvatore Buscemi is joining the show again, one of our very rare repeat guests. And I got to say, I heard, I think it was you. I think I found it on YouTube. Sal talk about this subject that we're going to get into today, which is about calling the capital, right? When it's time to raise money and bring the capital, how to do that without looking like an idiot, quite frankly. Those are my words. Those aren't Sal's words. But guys, you want to get a notebook out right now. You want to get a pen and you want to take notes, because this is going to come fast and furious. I promise you, I've heard the presentation, and I just can't wait for you guys to hear it. But first of all, Sal, just welcome to the show, man. I'm so grateful that you came back and you're willing to do this.
Tate, it's a pleasure and a privilege to be back again. I don't know if anyone has really had the prominence to be asked back. I sort of feel like this is being asked to come back to Saturday Night Live, if that makes sense.
It is. You know, Mr. Neil Bawa is our only 3-time performer, so to speak.
Okay.
But you're in rare air here. You're in. I can count on one hand how many people I've had on the show more than once. So, but guys, Sal Buscemi is a titan in this space. Absolutely, and the thought leadership space is transforming the industry, transforming lives. And here in the multifamily space is just an exciting thought leader that's bringing so much wisdom and experience and like original thinking. And I think you guys are just going to be blown away. But real quickly, Sal is, for those of you that didn't hear the first time he was on, Sal is the CEO and co-founding partner of HRN LLC, which is a private multifamily investing office. He's also CEO for Dandrew Partners Capital Management, which is his own investment office. So he's also the managing partner for several other direct investment vehicles across several asset classes in commercial real estate and credit, fine art, private credit facilities. How's that, guys?
That was a mouthful. That was impressive.
Yeah, well, and like I've never uttered those 5 words together in one sentence before, but fine art, that's awesome. Special situations and several well-performing life sciences investments, among several others. He started his career at Goldman Sachs. I think I've heard of Goldman Sachs before, in investment banking in New York City. So just a wealth of knowledge and experience, and as much charisma as you can possibly put in one human being. So anyway, Sal, thank you again for being on the show. It's so good to have you back.
Thank you very much. I hope I provide a lot of value today for your listeners. It's been special, and I know we've been planning for a month. So
yeah,
fire away. Yeah, I'm here for you. You have all my New York energy today, Tate. So
cool. Well, appreciate that. New York energy is good energy. I love that city. I love the area, and the people are real. Let's put it that way. So, but you're in Miami today.
Well, I mean, they call it the sixth borough. Yeah, I recently moved here, and a lot of people have sort of moved from New York down to Miami during the pandemic, and there's been a huge migration actually with people who you never thought would leave California who have moved to Miami or Miami Beach. And the principal reason for that is manifold. It's mostly political. But it's interesting because you're starting to see that drive real estate values throughout the roof throughout Miami. When you're hearing about home prices going down in Miami, they've actually been stabilized or going up because it's its own ecosystem. So it's a great place to network. It has a very, very hot vibe. People don't go to bed until 2:30. And I think Statista rated the restaurants being number 5 in the country as far as Michelin rated. Compared to New York City. So, it was snowing yesterday in New York. I haven't been to New York since December, and I have no plans to go back for a little bit.
I think that was the first snow they've had in a year or something like crazy.
It's depressing too. Yeah. Easter's around the corner, which is even worse. I mean, you want eggs and egg hunts and spring flowers.
Right. Yeah. Well, and that's in contrast to the 15 feet of snow that we've got out here in the mountains in Utah, the Wasatch Mountains. It's been the biggest snow year I've seen in 24 years. And wow. So anyway, Sal, let's just jump right in. Calling the Capital. First of all, listeners, go to callingthecapital.com right now if you can, and go ahead and download Sal's book, which is free. And it is going to rock your world. It's 26 pages of just gold. Basically the hardest thing to do in this industry, in my opinion, and I think a lot of people's opinion, is exactly what we're going to talk about today, which is moving the needle on rounding up capital, right? Like getting people to wire funds to you so that you can use their funds to go buy real estate. So I love this approach that, how to do this without saving face, essentially, without sounding desperate, is the subtitle. 20 ways to incorporate urgency into your capital raise without sounding desperate is the subtitle of the book. So like I said, callingthecapital.com, you got to download this ebook and consume it. And like I said, get ready for it to start coming fast and furious, because Sal brings the fire. So just jumping in, Sal, the squeaky wheel always gets the grease is the first big headline in the book. Let's start right there. Talk to us about what that means and what that's referring to.
The most expensive commodity today in the world, and as a podcaster, you would appreciate this, is attention. And you have to get attention from your investors. And in order to do that, you need to be able, we have a very interactive family office structure we use where we communicate with our families on email, almost on like a daily basis, or, maybe every other day. But we're always sending out good news, because if you're out of sight, you're out of mind. And especially with investors, that if you're out of sight, then they think something nefarious is going on automatically. I mean, this is just human nature, right? So we're always on top. I know you get our emails. If you don't, Tate, I'll put you on them. And anyone who downloads the free ebook, the 25-page guide, and called callingthecapital.com, if you get it there and only there, then you'll be able to, I'll onboard you onto our multifamily office platform for new families that join. And what you'll see is that there's an interactivity there. And if you're willing to be interactive, you're going to see a lot of success there. And that interactivity is being in front of people all the time, whether it's through a podcast or whatever.
Yeah. Yeah. Very cool. So
think about it. People are paying more for attention today than they are, comparatively speaking, for oil.
Yeah.
And if you look at all the wealth that was created during the Industrial Revolution, that was mostly, from oil, right? I mean,
Oil-based, yeah.
by and large, yeah. Today, it's all media, and if you own your own media and you're on top of it, I'm in an apartment complex in Miami with Bang models with 3.2 million followers. They make a lot of money. They drive expensive cars because the oil today is the attention that they get. Does that make sense?
Totally.
Okay.
You bet. So did you say you're in basically daily contact with, are those your active investors? Is that your entire investor base?
Everyone. So I treat everybody like an investor. Then this way we don't segment it. Now, if it comes down to forms and everything, but as it relates to communications, we follow a convention where if they open an email and they like that subject, for example, it's a deal we're closing on that has, the CEO, it'll be his 15th exit and his 8th unicorn. If you open that email before Tate, you're going to get that open. So it's not like we're spamming them all the time, but we're being very direct with it when we communicate with people saying, hey, we have good news. We have, everybody gets to see, and we're treating everybody with an investor because it's only a period of time before people see what's happening. They see the success and they want to jump on board, but they would never know about it if I didn't spend the time, maybe an hour each day crafting an email.
And are those like educational value add type emails? Are they updates mostly on your properties?
They're mostly updates on properties and our portfolio companies and our venture funds. And if you go to hrn.llc, you'll see some of the names there. And that's really just across the board. Whenever we get an update from one of our CEOs, right now we send an email out to them saying, hey, here's a letter just to investors. On some updates. One of our companies, for example, Avive, is a AED. It's a defibrillator that, if you think about it, the horrific parts of the country today, horrific consequences of youth and sports today is that there's a lot of sudden cardiac arrest. And now every football field, every mom will have something in their purse that they can power with their iPhone. And that was a company with two 27-year-olds out of MIT. And they were the youngest to get the FDA approval for their device. So these are, some of the good news emails that we put out. Even if there isn't good news, there should be some sort of a market commentary. I talk about that. I write some letters, and I really incorporate a personality of how I feel about things into it. And that really is, people can read that. And I've had other businesses where, I've had other people write emails for me, but you lose that authenticity, and people today really want authenticity. Yeah. And the problem with raising capital, and if anybody's listening to me right now, and I think since I moved to Miami, I've realized this, is that crypto as a whole, and I think to a degree, trading stocks and equities, retail stuff, if it's turned a lot of investors or people who are gathering AUM like your listeners into more transactional modes, not so much relational. And everybody wants a relationship with someone, right? I mean, nobody will ever give you their money without giving you their time first. And a lot of people are just like, hey, how are you? You're a family office? You must be down to write a big check. No, I mean, it's like going up to a female at the bar and saying, do you want to get married? It's creepy because a lot of people don't have the bedside manners. And that's why I put together this little 26-page guide. Yeah.
Yeah. All right. Well, let's jump into that. So kind of walk us through that. When you're talking to, and for listeners, this is a different conversation than talking to your retail $50,000 investor, right? That's just an entirely different strategy, different languaging.
Well, no, I mean, this is something that is great for both investors. The ones that we work with, the investors we work with, are a lot more institutional. So, you're dealing, the money always has a voice at that point. However, even with the smaller stuff that we do, such as life sciences, you still have to do something. And real estate is something that everybody understands sort of at a visceral level. They don't understand. They think that the numbers don't matter, but they do. And we're starting to see that right now. But when you're trying to do other things, such as earlier stage oncological companies or device companies, I can tell you it's a very hard sell because nobody likes to invest in that stuff. It's boring. Nobody wants to sit through a pitch. That nobody wants to be browbeaten and quant-splained by a PhD. And so we've had tremendous success raising millions and millions of dollars in capital for this. We're closing close to $2 million on a life science company I was telling you about earlier. That's the equivalent to $200 million in real estate. It's a lot of money. But there's also a lot, they're more of a binary bet. But you have to communicate to the people the same reason, because everybody at the end of the day has emotional drivers, which we'll get into.
Yeah. Yeah. Okay. Cool. Well, let's start right at the top. So the 20 steps here. Let's start at step one.
Step one. What is it? Read it to me. Is it deadlines?
Let me get. I'm too busy. I'm consumed with you, Sal. I don't have it in front of me. So here we go. Okay. Step one is. I'm getting through the intro here. So always use deadlines. Yes.
This is something that every investor is afraid to do. And especially if you're raising money to invest equity from LPs and syndications and the sponsor deals, you have a deadline. But it's always a sign of a novice when people don't have a deadline, because it feels as though that they're insecure to ask the capital. However, think about it. No hotel would ever, they would have a problem with vacancy, with people never leaving, because if they didn't post it, you had to check out by 12 p.m. or whatever. So, that's part of like the negotiation tactic. But when people know that there's a deadline, they look at it a little differently, because as soon as they see it the first time and there's nothing that's locked in their mind as far as a fear of missing out on anything, not just the deadline, that's where things become problematic. And then people are like, well, they don't want to take you seriously because you don't have a deadline, or, how do I know you know what you're doing? Because it's sort of implicitly, and they will never say it, but it makes for me, when I see this, that there's no deadline for anything, it makes me feel as that I'm not comfortable working with that person. Yeah.
Yeah. You say it right here. You've destroyed any status that you had with them if you don't use deadlines and put that like front. You put it right in the middle of your all your emails, your communications, like big bold letters in a block, deadline for funding January 31st, 5 p.m. New York City time. Like that's as specific as it gets.
Yep, that's it. And now everybody knows New York City time. Okay, what time is it in New York? Ask Google, right?
Yeah.
It's just very, very straightforward. But you have to do that, because that's going to actually be one of the things that if you stack it with 19 of the others or not, you're going to see a lot more success with that money coming in.
Mm-hmm. Got it. Yeah. Okay. So number 2, use investment tranches.
Yeah. A lot of people, and you'll see this, the beginners go out there and they'll talk to a lawyer first, but they have no idea how to market their fund. And they think that the PPM and the operating agreement are the marketing documents, and they're not. And they're just boilerplated documents that everybody knows, that don't really have material changes to them, unless you work with like a top global law firm like Perkins Coie. Then you're like, okay, these guys are a little smart. The problem is that once you put those investments out to people, and if you don't deadline them, well, first of all, if you have too big of a goal and you want to raise, like, let's say a $30 million fund, but you've only raised maybe $300,000 and it's been 6 months, people are going to be asking you what's taking so long, right? So what you want to do is you want to front stack all the incentives into one of 2 tranches, and that would be the first tranche. So it would look like an inverted pyramid, right? So you put up here all the goodies and everything, and if they miss that deadline, guess what happens? They go into the second tranche. And then the second tranche, people are like, oh, I missed out. And the second tranche, you don't get the free ice cream. You don't get the free dessert. It doesn't come with the Caesar salad. It's just a steak. That's it. And people really, when we talk about this more, people do want to get invested into these things, but these are just sort of the emotional triggers that are used by institutions as well to be able to market to investors to get them to move faster.
Mm-hmm. Yeah. I mean, you look at any time sensitive marketing that's got, anything that like a deadline in it, it is always going to be emphasized, and it does create scarcity and the FOMO, so to speak, the fear of missing out. So, and so that really kind of goes into number 3 really well, which is stress the potential for missed opportunities if the investment is not acted upon immediately.
Okay. So this is in New York, we call it spanking the investor. If they don't participate at all, if they're dragging their feet, then at one point you have to make sure that you outline the boundaries of the relationship. And what we do by that is saying, look, if you don't close on this real estate deal, you're making me look bad because this is my reputation on the line. You're never going to be asked to be on a real estate deal. You spent 3 weeks looking at this. You had your brother-in-law who works for Raymond James look at this. He's not qualified to look at a capital structure. We both know this, but I'm playing along. And we know that, your other basement dweller, son is playing around with the model. He doesn't know anything because he's trading off of Reddit all day, and he's just basically going around the model, pressing the arrow keys like a tourist. So you have to be really frank with these people, and they want to pretend that they know what they're doing. They don't, but it's sort of straight talk and say, look, my reputation's on the line. Okay, it's not about you, it's about me. They don't care about you. It's me and my relationship with the sponsor. I'm not going to put myself in harm's way because you can't make a decision. And if that's the point, then maybe you should sit out the next one too. Now all of a sudden you've reframed it. No, you have to have these tough conversations, especially if you have to hit a bogey, Tate. And people are too timid, and it's really a function of just sales and persuasion.
Right.
And that's something that people fail at. And that's the reason why I put this together, is because 2 weeks ago, I was at the Florida Ventures Conference, and all these guys had the bedside manners of like the Grim Reaper. They were just coming over with an iPad on there, and they're like, hey, you're Sal. You must have money. Hey, and then they start swiping. I'm like, no, I'm not going to sit here and go through your entire pitch. This is really, really rude. I didn't say that. But at the bar later on, the same guy comes over and he opens up his iPad and he just sets it up. I'm like, would you put it away? I mean, I just want to I get pitched every day. Yeah. And so you really, you have to really understand that all of your investors are getting hit over the head with opportunities, but you're the one that has to sort of, make sure that they're absolutely clear.
Yep. Yeah. And you the word spank, like that's a spanking verbally speaking that you give them.
No, it's trust, because if you haven't written the check, if you've been talking about it and you're leading me on and everything, just say, look, I'm not used to working with investors like this, and none of the other investors at this point have taken as long as you have. Okay. Yeah. There are guys in here. I know your $50,000, $100,000 check is a lot of money to you, but for the bigger guys, they don't really care. I need an answer by tomorrow, Tate. Okay.
Yeah. I love it.
All right. Now we can be friends again. All right.
Yeah. Good. And if for listeners, like, a really good salesperson is helping, it's really empowering who you're trying to persuade to make their own decision and make them feel like they made their own decision, even though they're doing essentially what you want them to do. Right. And so, like subconsciously, a lot of investors probably want to hear that level of direction, from.
They do. Everybody wants to be led. Everybody wants to be led. And they're looking at you as the leader.
Right.
All right. But you have to explain it to you that, look, my reputation is worth more than your money.
Yeah.
Otherwise, we wouldn't be in this deal in the first place.
Yeah. Yeah. So number 4 is the kind of the flip side: offer incentives for investing quickly, such as bonuses.
Okay. There's a lot of things. I mean, I don't know if that's the one where I talk about the deal toy. I don't want to look at can you just read the next paragraph on that one?
Yeah. Basically it's not a deal toy. It's, so when you set up Dandrew Partners Ventures, you change the incentive structure to show more of an alignment of interest between you and your investors.
So here's a funny story. Back on Christmas Eve 2018, we launched Dandrew Partners Encore Ventures, and it was a fund that was put together, smaller balance set, basically where we were able to corral a bunch of cowboy investors into a bunch of earlier stage life science companies, which have since gone very, very successful. And we have a lot of good news, and I'll share that with you on the State of the Union. However, one of the points is that everybody on Wall Street, they think that they just copy each other, and they're very mechanical about it, and very they don't put any thought into it. And I'm like, how am I going to get these people to just go straight to due diligence and return the phone call? And what I did was I modeled something out that was very impressive to them, although it just took me a night to think about it. But everybody's very fee sensitive today, especially wealthier investors. And I said to them, like, look, I don't want to use a fund structure. We have to use a fund structure, but in order to and here's why. There was obviously context. And I said we were making a lot of these investments really quick, and they were my partner Bill's picks, and they all had like opportunities to invest alongside world-class families like the Estee Lauder family or the Emerson Collective and families like that. And I said, what I did is said, like, here, I'm going to answer the itch right there. And that whole, rub was, the 80-20 or, the fees 2 and 20. I said, look, I have so much conviction in this. that you have to make 200% back before I make a dime. And then after that, we split it 50-50. Now, because I'm better at math than most of the investors, I make more money off of that in the back end. But the fact that they're getting a 2x before I do emotionally triggers them to have to take action, because now it seems as though that they're getting something for free and they're already winning. Does that make sense?
Yep, totally.
And then after that point, everybody went straight to due diligence and everybody followed the deadlines and the tranches. We're going along with this now. Yeah. See how it all comes together?
Totally. And the first sentence here, you don't create urgency with discounts. I love that. Like, you cheapen what you're offering with a discount, right?
Yeah.
And you discredit yourself right away. It's like, what do you mean? Are you bribing me to get in this deal, or is the value really here, right? Like,
I think it's really lazy thinking. And if you're running a conventional fund structure, which I have, and it's very successful, but running a fund, you have to like mark your books, and then you have cross promotes and everything. There's all sorts of things where we don't use that structure. And if people want to know what that is, I'll onboard you to the HRN, multifamily investment platform as a new family investor. So you get treated like an investor. But one of the things about the fund structure is that it requires an operating expense. And 2% on, $100 million is only $200,000 a year. Okay. And when you look at inflation for services and for, just everything, getting people to work today, there's wage inflation and everything that happens today. So all of your fund administrative, your accounting, and your legal, the prices have gone up. But if you're cutting fees, you're really you're really doing yourself a disservice. But not only that, the smarter investors will notice that they're going to say, how the hell is Tate keeping the lights on? What is he doing? Like a side gig or something? They don't want to see that. They want to know. And if you justify it with them, and this isn't like a sense of urgency, but when it comes up, you say, no, we have to pay the bills here. You're paying for, the services here. This is customary, and this is how it works in institutional America.
Yep. Yeah. It's the industry standard, right? Why would you expect any different? Absolutely. Number 5, mention any regulatory or legal factors that may affect the availability or value of the investment.
Yeah. Read me the first paragraph on that. So I don't.
So it goes without saying that all of this should be laid out. Most people don't, and assume the investors know what they don't know, right? In real estate, this looks like 1031 exchange deadlines or recent tax code changes being proposed. Perhaps how interest rates are rising or dropping, with an explanation of how these relate to the performance of your investment opportunity.
Yeah, I mean, that has to be, I think the 1031, you always hear like somebody needs to do something and you never know why. And then you find out it's the 1031. Something needs to move. You need to make sure that you use other people's urgency as your urgency to lever against, so that you can actually push your investors against the wall. That's really what it means. And there was a time there when, they were going to change the tax code, and they were selling, people were selling companies, back during the Obama administration, I think. And, there was going to be, and people were selling, that created a tremendous amount of urgency for deals to get done. And that's really what you need to repeat into your marketing too, as part of your messaging.
Yep. Well said. Mention any partnerships or collaborations that may enhance the value of the investment.
Okay.
And, when raising money, family offices are major players today, as they're incredibly agile and add a lot of reputational capital when investing into businesses that match their core industry. This could be like sports owners investing into AI-based sports recruiting companies.
Very cool. Yeah. Okay. So what this means is, and you should be, if you're looking at these deals, is they should all have a big lead investor like we do, or a big lead family. We only do world-class statement class real estate, class A, that means. And what it is, hey, you're invited to invest alongside this family who's been around for, doing this, development for 50 years, say. And that deal is perceived to be safer because they have deeper pockets and they're putting in, 50% of the equity, and we're coming in with the other. And there's a true story actually of one of our deals. And that's sort of, if you communicate it that way, where there's smarter investors alongside of you, we call that pari passu or whatever, just involved in the deal. then that adds a tremendous amount of credibility, because then the whole dogpiling convention happens. People just start saying, well, I'm, this is like, I'm not saying, say it's a prominent European family office that's investing into a building in Miami, and I tell you that, you're going to be a little more interested, aren't you? Yep. Because what you're building there is not only safety, but status, because you're going to go around town telling people that you invested into a company run by, whatever famous name you can think of, because you're elevating the status. And if you tell your investors that, then there's going to be very, very, it's going to facilitate a lot of credibility, but it's also going to make the capital flows faster too.
Yeah.
A lot of people don't do this. I'm like, who's the lead in this? Oh, well, it's, this, very famous family. I'm like, they're a very famous family in New York. Why are they not here? Well, and then all of a sudden, when you start tweaking things around in their messaging and emails and promotional materials, wow, that money starts coming in.
Mm-hmm. Yeah.
Right?
Who knew, right? Absolutely.
Who knew?
Emphasize the expertise and track record of the team or organization behind the investment.
Mm-hmm. Okay, this comes in two ways. So when it comes to anything we do in venture, we have two rules. Number one, they have to have a lead family in front of us. And we've done a lot of successful deals with this. We're usually the ones that go in for like 1 or 2 million into these venture deals. And we like that because, of course, there's safety in numbers. Number two is we also like CEOs, and I'll explain how this works in real estate. We also like CEOs who have had multiple exits under their belt, not like, they were part of a company and, had stock and cashed out. They built a company and sold it. You know exactly what I'm talking about. And those are the guys who've done it over and over again, regardless of economic circumstances. They're the ones who wake up in the morning and have the grit and determination to know what needs to be done as far as an operator. But they also have the network too to draw on if they had any problems. Now, in real estate, we have rules, and those rules are, before we even look at anything, I want an operator who is, putting down a meaningful equity contribution, right? So I want a strong, sponsor co-investment. I know a lot of the people who are emerging and new in the space, they, pulled together from grandparents and uncles and bruncles and all of that. However, when you're dealing in the big boy league, I want to make sure they're putting in a lot of money. 5% is cute, 10% is thoughtful. Anything more shows conviction. And the higher the conviction, the better, which is why we only like to work with families that have operating companies that throw off so much cash that they can, that they're actually have to put it into real estate, if that makes sense. Yeah. The other thing that I want too is I want them to have been through at least 2 economic cycles. 2008 was one. But I want them to go back a little further. I want to see some gray hair. After all, we're asking people to part with their life savings here, right, Tate? So we have to cover our assets. Yep. And third, I want to see an audited track record. Their track record's so good, why isn't it audited? You pay $2,300 to have a top 15, accounting firm do that for you. Yeah. And that's really what it is. It's that we headline with this stuff. And when you start talking about it and you start laying out the rules, then that becomes persuasion.
Yeah. 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 You're establishing your expertise and your status. Like, yeah.
Exactly. Like, I know what I'm talking about. I want these 3, and you can copy those 3 things. I don't care, because it'll make you sleep better at night if you follow those things. Yeah.
Yeah. So those 3 things again, what number one was the sponsors bringing a very strong capital contribution, otherwise known as skin in the game. Yes. They've been through at least 2 economic down cycles. And they have an audited track record, which, that's a fascinating idea. We have a great track record, but it's never been audited.
So. You got to audit it, Tate, because that's marketing and urgency. See?
Yeah. Yeah.
There you go.
I love that idea. Yeah, takeaway. So. Yeah. Tate's takeaway, big takeaway so far. I love it. Okay. So use this is so key. And to me, this so far out of all of them, this one really is so important, but use persuasive language and storytelling to convey the potential benefits of the investment.
Yeah. In real estate, it usually has to do with the families that are linked to it, or the building, the history of the building itself. A lot of people, and if you're not from Wall Street circles doing buy side and private equity, everybody follows like that you need to have a pitch deck, but we don't do that. What we do is we actually use video. So we use video, and we retained actually a PR person and a former investigative journalist, Christine Haas. And what she did was, just from her studio, she was narrating a story. This cost me a couple $100. And I had a kid with a drone actually just fly around the property.
Mm-hmm.
And it was basically me talking about the property. There was an email and everything, but it was talking about the property, why it was important, why we were doing this. And it was also answering a lot of their objections too. For example, we were investing into a Class A industrial facility that I underwrote at a 7 cap. It's right now throwing off like the equivalent of close to like an 8.75 for this Class A industrial, right? So people, but the problem is that you have to start talking to investors, and different investors don't know things. And your middle class investors, although you might think they're rich, they don't know any better. And they're always chasing risk like a wine list, right? Over to the right and down to the bottom. Must be the most expensive, must be the most delicious, right? So that doesn't work in real estate because that calls risk. And you'll see about it is that a lot of wealthy families don't want to take on the risk of having, multiple single family homes. That'll never happen because of economies of scale. But, this one guy was doing like a multifamily C to B, and he was like, well, this guy over here, Tate's he's giving me a 16%. I said, that's fine. I said, but where you are in life, you can't afford to have tenants who are poorer than you are. And at that point, he wrote a big check into my deal. Does that make sense?
Totally.
So, it really went, I mean, he's very happy the way it is now because the pandemic happened and tenants weren't paying rent and interest rates went up. But when you explain it in a certain way where people understand it, then it sticks in their head and they're always obsessing about it. Right? Yeah. Think about that for a moment.
Well, and I love how you just used a story to make your point.
Yeah.
about True. The power of storytelling.
Yeah.
And it's really, you say this in the book, it's really, as far as public speaking goes, it's the most powerful tool you've got is the power of telling a story.
Absolutely.
So listeners, get good at telling good stories, practice like with your family and friends, and practice in front of the video camera, in front of Zoom meetings. One thing, I had a very successful consulting client come over to me, and he was looking for an idea because he's from Kansas City and he was in Miami, and we were talking, and he said, what's a good thing for me to do as it relates to a story for an apartment complex? And I said, what you should do is, and I'm being honest, I said, you should talk about the story of why this building was built in the first place in 1929, what happened to it, and what is going to happen to make what you're going to do to turn it around, not for the tenants, but for the general community to make it much more of a shining star. Mm-hmm. And guess what happened? After a few drafts, he nailed it. And, and then we get into some other things, but, people watch video today, and video goes around the world fast, and we'll get to that in a moment. Yeah. Yeah. Mention any exclusive access or privileges that the investment offers.
Okay. What does it say after that?
It's the Bectus Pharmaceuticals story.
Oh, okay. I think it's the one. So we invested in a company through our venture fund. Through our family office called Apricity Health. Apricity Health is co-founded by very impressive people, Dr. Linda Chin, and also a Nobel Prize winner in 2018. Dr. James Allison for physiology or medicine. Now, for my family office investors, I want to get the biggest check, as soon as possible. And what I said to them, and that we're doing this actually concurrently right now after we finish one of our deals with Thrive. I said, if a family comes and writes a ticket for $1 million, do you think that you and Dr. James Allison can have lunch or dinner with that investor and their family? And they said yes. Okay. So I said, well, what happens if 2 people write $2 million checks, Sal? I'm like, well, we'll just have 2 different dinners or 2 different lunches. So you have to put together something around it so that people can sort of be appreciative of that. Yeah. For, I think, your investments, what I would do is, especially for multifamily, is if you're doing a rehab, if somebody writes a check for a minimum of like $250,000, put them on the roof of the building if it's safe, and have a drone fly around taking a picture of them, because then they'll forward it to all their friends, and all their friends will think that they bought the building, not you. Does that make sense?
Absolutely.
And so it makes them look like, now it could be a $10 million building, but nobody knows if that guy owns 20% of it, 100% of it,
right,
or maybe just less than 1%, right?
Yeah.
And that is what the special perks are. So when you start looking at it from that standpoint, and I've seen people do this, they're like, I'm going to take professional photos in front of this because again, this is part of people's life savings, and they're fully invested into this.
All right. So highlight the potential for the investment to provide long-term financial security. Again, what that looks like. Do you want tenants poorer than you paying you rent, or tenants who are richer than you are?
It's interesting. I wrote a third book. It's called Investing Legacy. And if you go to investinglegacy.com, you can buy it, and it's an autographed version. Otherwise, you can buy it on Amazon. However, one of the things is that there was a tech founder who sold his company, and he was looking to put together a nonprofit for sensitive social causes. And it was very sensitive. And I said, well, how are you going to finance this? Right? Like, what's the lever here? What's the fulcrum? And he said that he was going to invest in this guy's multifamily outside of Atlanta. It was like, I don't know, like a 50 unit Class C to Class B value add. And I said to him, you can't do that, because those tenants are not going to pay on just because they are charged rent doesn't necessarily mean they're going to pay rent. And during the pandemic, guess what happened, right? So you have a lot of these things that people can't control in certain asset classes where it could hinder your reputation. And when you frame it that way to the needs of what they need, this guy, it was a very conservative family. They did not want to be embarrassed, right? It was a very conservative Asian family. They did not want to be embarrassed. I said, are you really going to support something with your last name in beautiful bronze copper across the top of it in Southern California, funded by people who you don't know are going to have a job tomorrow or not? And at that point, he started to say it was much more, because a lot of people are trained to look at real estate for the numbers. They don't know what the numbers mean. They have no idea what risk mean. Again, they read it like a wine list, over to the right and down. So it must be the best. And I can prove that to you. However, it's very difficult for people to see that unless you put it in some sort of a narrative.
Yeah. Right. Yeah. And storytelling. That's your narrative right there. And here's another one. Use case studies or success stories and testimonials from previous investors to demonstrate the potential of the opportunity. You should have a video testimonial file that you can show to prospective investors on demand.
Yes. Okay. This is very important. This is something that's it's building sort of like the urgency, but if you put it into an email, it works wonders. After the pandemic, or when it started to cool down, I spent a lot of money, tens of thousands of dollars, to have a camera crew go around Manhattan and meet family offices, and actually an ex-boss of mine who was on the investment committee at Goldman Sachs. And, asking someone like that for a testimonial is, a lot of people don't like to do that. Let's just say it.
Yeah.
The moment that email went out, when we were doing a raise for this one company, money flooded in, because people started coming in as part of a story that was already going on, and they wanted to sort of be a part of it. And when you see someone's history, they want to come into the present, and it worked really, really, really well. I'll send you that by text message. You'll blow your socks off, but I'm not going to show that. That's like that's like the superpowers. If you can get investors, and you can actually. And it doesn't have to be fancy, although my investors, require some level of fanciness. But even if you're getting an investor to talk, and you hire a college student a couple $100 to put it together with proper lighting, and you have them come in, that would work. And one of the ways I've seen people do this is, and we're probably going to do it in Boston, is that we have a lot of investors in Boston, but we also have a lot of CEOs in Boston too as well. And what we're going to do is we're going to just basically rent the back room of a Fogo de Chao. We're going to feed everybody, and they're going to be interviewed professionally by someone. And then that footage will be used for the testimonials going later. There's a little hack there.
How long should those files be?
I am not privy to like the rules and everything, but I none of them that I have are more than 4 minutes.
Yeah. Edited and produced nicely.
Edited music and very well produced. Yeah. And you can do that on Upwork.com. You can say, hey, put in some filler, some, B footage here between the testimonial to make it look good. And if anybody really wants to see what that looks like, they can contact Tate.
Well, yeah, and download the book, because there's two examples. There's links in the book to two video examples.
There are. I forgot about that. Thank you.
Yeah. So, so again, listeners, callingthecapital.com, you got to download this ebook. It's worth its weight in gold. So here we go with FOMO again. Highlight the potential for the investment to sell out quickly. That's pretty much speaks for itself, right?
It is, but you have to stack it with the reason why. And the reason why is because you have a lead investor. Let's just say it's Warren Buffett. Okay. Warren Buffett's coming into this tranche. It ends, the date, is X New York City time. This is when it is. If you don't come in, that's fine, but you're not going to be able to invest alongside Warren Buffett. Does that make sense? Yeah. So there needs to, so you have to stack that one with a reason why it's going to sell out is because everybody's coming in and there's only so much that you can give, because if you start giving away to all your investors, you become oversubscribed. Now, oversubscribed is great. However, you don't want to dilute the existing investors. So you say first in, first serve, so we don't dilute those who come in first. The reason for this is because Tate's family office is coming in with a $50 million ticket, and he has expectations of closing this fast. Mm-hmm. Does that make sense?
Absolutely.
Okay.
Yeah. So mention any potential for the investment to provide a unique or exclusive experience. And you talk about your investment in AIScout.io.
Oh gosh. Yeah. So this is a very interesting story. One of the things that, so this is a true story from August this past year. If you know anything about Wall Street culture, New York culture, European culture, nobody likes to work in August. Not very industrious. People go on vacation. They're out in the Hamptons. They're just doing their summer thing.
Yeah.
And usually there's a convention in Wall Street that's called the deal toy, and the deal toy is usually an overpriced, customized piece of acrylic. And it says, you invested in Airbnb, and I have one. It's like, yay, and then, it's a gift, and it's sort of seen as like a medal of honor, sort of like if you hunt, you have like all these heads up there, right? Like $1 billion, acrylic things that say, hey, this is my unicorn. And I'm thinking to myself, no hunk of acrylic is going to get anyone to no matter how charismatic I can be, no matter how persuasive I can be, there's only a limit where I'm going to have to get someone to get off the couch and really do this. So at the time we were investing in this company called AI Scout, which has a lead investor called Raptor. Raptor has a very successful investment portfolio because it's owned by professional sports owners. And it's an investment platform. It's very, very formidable. And they've invested in FanDuel and Fanatics, right? And these companies are just going up in value. Mm-hmm. So they invested in this company called AI Scout. At the time, the person who was making investment in AI Scout was the current owner now, who bought it from Abramovich, Todd Bowie. And Todd Bowie is an investor into AI Scout. But he also bought the Chelsea Football Club. Mm-hmm. So I called the CEO at AI Scout and I said, look, I have an idea. It's August. I'm supposed to be, on vacation. I'm not, because this is one of those world-class opportunities. And it's already been marked up 5 times since the investment. And I said, I have an idea. And I said, if you can get each one of my investors to get a customized Chelsea Football Club jersey signed by the entire team, I think we can hit the bogey on here of, $2 million. I'm like now sitting like, let's see what happens, right? So next morning, they're in London. Next morning, he calls me. He's like, Sal, he's like, it can be done. I'm like, thank goodness. So now and you'll see it in the book, there's pictures of the jerseys that we sent to our investors because they invested and moved quickly. Now, do you think that they were investing in the deal because it was a great deal, or because they were investing in, the premium, which at this point is a Chelsea Football Club that is signed by the entire team? There's only 2 things you do with that. You let your kid wear it to school, which is a bad idea, or you frame it, in glass, like when you go to those sports bars, and you put it in your man cave or in your living room. Right. Because now people are like, now you're thinking about all the people you can show that off to. You're not even thinking about the investment. You already know it's a great investment and everything. I'm not saying, and these people do due diligence and everything, but to get them to do the due diligence, you have to really give them something important and of consequence. And when you tie your status or their status to it, it becomes an entirely different construct, because they're more focused on that jersey and the status that they receive from having that in front of their friends, and the attractiveness in front of people of opposite sex, and all of that, because you're deemed to be smarter, more connected, and more sophisticated, overrides, the pain that you need to go through to send a wire or to fill out documents online.
Mm-hmm. Right. Yeah. a soccer jersey, guys. That's like, how magical is that, right? Emphasize the potential for the investment to provide a strong return on investment.
All right. What does that look like?
Yeah. So great for stabilized investments, otherwise called core investments in real estate and income producing funds.
Yeah. People don't talk about this. And what they do is they'll send out apartment deals. And I see this all the time, but I'm like, is it stabilized or is it value added?
Right.
And people don't know that. And it's a confusing thing. And when you say it's stabilized and a lot of bad things have to happen before, you lose money, that sounds a lot more attractive to the investors rather than them thinking that there's a lot of good things that need to happen before they get a check much later on. Mm-hmm. Here you need to prove to them and explain to them, and a lot of new investors don't do this. Is this currently stabilized? Not everybody's looking for, value added deals, especially people who have a lot of money. We have one investor that makes $2 million a month off of royalties. He's looking to put it somewhere. Mm-hmm. If you look at the founder of Zara, he spent $2 billion buying Class A properties around the world for cash. He has different capital sources, have different needs, right? But if you start explaining it that way, where it's something where it's a little more stable, especially in multifamily and apartments, you're going to get attraction.
Mm-hmm. Yep. Mention any recent news or events that may have increased the value or the demand for the investment. And I've got one on this, which is, we put a property in Northeast Columbus, Ohio under contract. And during our due diligence, this little startup called Intel came out and announced they were building a $2 billion factory, 8 or 9 miles from our site out in the cornfields. And a year later, a little more than a year later, there's been, dozens of smaller tech companies that have announced they're moving there, are going to set up some sort of office there, satellite office, et cetera. It's going to be like a whole new city up in the northeast side of Columbus. By the time this, 10,000 jobs in phase 1, and they're talking about 5 phases. So that really ignited the value, obviously heavily influenced the value of the property. But because we were raising when that announcement was made, it was like the timing was just perfect.
We did that when Tesla announced that they were moving to Austin. And then all of a sudden the money started flooding in.
Okay. Yep. Yeah, it makes total sense. So use urgency language such as act now or limited time offer. Just spell it out. Spell it out in your email.
Black and white. You have to, especially in emails, you're writing an email. If people think they're writing it, they have to be personalized. Dear Tate, this is something you need to take action now. This big investor over here is expecting us to close next week.
Mm-hmm.
Please act now. Okay. Please act. You've known about the deadline. You repeat the deadline. Please act now. I want you in this deal. The best response is a signature. Thank you. And then send them the docs.
Perfect. Yeah. And here's another example. We have only $200,000 left in a $1 million allocation into this real estate deal. Please act now. This has been one of our more popular offerings in a long time. And only 2 more investors will get the Chelsea Football Club jersey autographed by the entire team.
So I'm stacking it. You see?
Yeah. So good. So good. So when you're in a real estate deal, talk about how often the investors will get paid.
Yeah, I never see this anywhere. Never. Especially on like stabilized deals. Everybody should be, buying, if they're starting out, you should buy a stabilized deal, not a value added deal. That's a whole other, and you should allocate into a stabilized deal. And, it's, a lot of people don't know when they're getting paid. Like, when am I getting paid? Quarterly. Perfect. ACH? Yes. Tell them. Quarterly ACH means to them that they have immediacy to funds.
Mm-hmm.
Okay. I know I have some people that don't ACH to us. We get these huge checks and I have to wait 2 weeks from the cash. I get it, but I'm not going to complain about it. You have to tell them paid quarterly. Okay. Now, here's a little trick. If you go back to the tranches, only the investors in tranche 1 are going to get paid quarterly. The other ones will get paid semi-annually. Mm-hmm. Wait a minute. I want to be in tranche 1. I want to be paid quarterly. Well, you were too busy, playing, racquetball, on the courts, when I was calling you and texting you and you were too busy, sure enough, later on, unless you want to spend more money to redo the documents, you always let the tranche 2 investors in the tranche 1. But with bigger deals, the more you go, you can't always let it slide that way, if that makes sense.
Yeah. Yep. Absolutely. Yeah. That's kind of the secret, right? Like, just because somebody ends up in tranche 2 doesn't mean you have to leave them in tranche 2.
Correct. Yeah. You'd be like, Tate, look, I know you had a life-changing event. You had a kid, whatever. That's fine. I'm going to let it fly this time. However, this is the third kid you have right now. So, I'm kidding. But the third time you've done this because you always have a kid. Right. So, but I mean, all joking aside, you have to establish the boundaries of the relationship, or your investors will not respect you. And just because they have money doesn't necessarily mean you don't deserve respect. Oh, I've had billionaires tell me, always ask for the check. Oh, do not be afraid to ask for the check.
Yep. If applicable, mention how rich the deal is now by communicating money being made at the buy.
Yeah. So you always want to show that in plain language, using maybe a chart or something, that you're getting in at a very good multiple. In real estate, the people, a really good basis. And that shows that we call that a multiple on invested capital. So we did a deal once with the Shimano family office into a company called Thing Life. And we were able to buy that and make that investment. It was our first cross-border deal in the fund. And the interesting part about it is that we were able to get it at a 1.35 multiple at the buy. So we made 35% more on every dollar that we invested into it. Since then, it's up many multiples because Aviva has come into it and they're in a merger right now. And that's going to be really cool. But you should really talk about how there's, the buy-in multiple here could be for something like, maybe if you compare it to market value or something, that you're getting it at a discount, but show it in a way where it's very obvious to your investors in big, bold font. Does that make sense?
Absolutely.
And then this way it shows that you're not overpaying for things, and you're not doing, you're not betting on rents to grow to the sky, and things like that, because there is a limit, especially with multifamily, to how much tenants can pay.
Yep. And last but certainly not least, mention any potential for the investment to provide access to new markets, industries, and networking.
Yeah. Where does that go?
Yeah. In your third book, Investing Legacy, there are some asset classes that just aren't available to mere mortals. For example, owning a professional sports team.
Yes. So this deal in AI Scout really put us on the radar with a lot of professional sports owners that I've been networking with. And we are going to be making a foray into doing that with some of our larger families. However, if you want to get in on that, Tate, you got to get in on AI Scout too, because we have to show conviction to these guys first before they let us into that club.
Yeah. I love that. I love the Chelsea FC example. It's so creative and brilliant. So those were the 20 steps right there. And here in summary, you basically just you really hammer home that the real magic is made in the follow-up.
Yeah. People today are distracted. Remember, you have to get attention any way you can, right? Look at people on Instagram. They own a lot of media because they're always getting attention. Whoever you follow is always on your feed. I'm not saying you need to do that, but you need to make sure that you're always following up with people on an email, and be very nice and gentle about it. Don't say you're following up. Just say, just wanted to drop you a line telling you that we have $200,000 left of this $1 million allocation to AI Scout. And, there's, somebody's going to get a jersey. I hope it's you, Tate. Best reply is a signature.
Best reply is a signature. That's gold right there. Right. That takeaway is so brilliant. And the other one that you have here is you just need to authorize the agreement.
Yeah. You just need to authorize the agreement.
Yeah.
That's it. Yeah. Right. Yeah. And then that's it. It works very, very well. I hope I provided a lot of value today. Am I doing well? Oh man. What do you think?
Sal, I think we hit it out of the park, man.
I hope so. I really do. I do. I hope your listeners, really, really internalize this. I just want to, I know we're going into overtime and everything here.
No, you're good.
But I just want to talk to your listeners and tell them that never to forget the second rule of real estate, because people are dying today because they don't know this second rule. The first rule is what? Location, 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 right?
Right.
The second rule, and if you're going to get a tattoo, I wouldn't get one, but maybe on your arm, never stop raising capital.
Yeah.
In real estate, you never stop raising capital.
Yeah.
And if you're able to build media and use these, these ideas and strategies that we use to be able to do this, the world's your oyster, because now you can raise capital for things effortlessly, as long as you're putting them into the right things. Mm-hmm. Remember, it's one thing to raise the money, and it's very easy in real estate, not very easy in life sciences, but it takes a tremendous amount of skill and understanding to invest that money appropriately. Mm-hmm. And, with that, I think, they're in safe hands with you, Tate. That's for certain.
Oh, I appreciate that, Sal. That's great. Yeah, we do our very best. That's for sure. Our investors are priority one. Our residents are priority 1A, right next to our investors. And we know that if we serve those two demographics in our world the best that we absolutely can, that everything else will work out.
Yeah, we care more about our investors. So, I joking aside, but they're the ones, if you think about it, though, it's that interactivity that they really like, right? They like hearing me on a video. They like hearing some of the, pictures from Art Basel, videos of me speaking, things like that. It really, really adds a lot of value today. And especially when you're building up that reputational equity, every time you make an ask, you sort of bring the gas tank down a little bit. But every time you serve, now you're at full. And then you ask for a check, and then it comes down a little bit. But in order to make it go down a little bit, you maybe do something where you sort of, keep them here. They're happy because they're getting a Chelsea Football Club jersey. Does that make sense?
Absolutely.
Right, yeah.
So you have, listeners, if you want more of this and you want to get really granular at this stuff and get masterful at it, Sal has a event coming up, the Commercial Real Estate Masterclass in June in Miami. You want to talk a little bit about what that's going to look like?
Yeah, this is not meant just for commercial, just for multifamily. It's meant for all types of real estate. But we're going to be talking about how to become a good equity investor, a good equity allocator, raising money, putting it together to be able to put it into these deals, to form your own syndications. And we're going to be going over a lot of underwriting, but we're also going to be talking a lot about the mechanics, fund administration, things like that, where people don't really sort of finish off what we call the post-closing conventions of taking care of the investors afterwards. So you got the checks. What happens next? Well, everybody forgets to, email their investors until, quarterly when they have another deal. And that's sort of like a slap in the face to the investors. So there's a lot more to this too as well. And then we get into the legal structures, because we have it hosted actually at a very prominent law firm based in Miami. We talk about the different structures. Some people use JVs, which is appropriate. Some people, want to use a fund structure for other things. It's not appropriate really for buying, a real estate deal. You don't start a fund for that. But we get into the granularities of it. So it saves them a lot of effort and frustration, and they're able to execute confidently without having to sort of get their hands dirty. And it's just basically is what myself and my colleagues do in New York all day long, and they'll be coming from New York as it relates to allocating equity. And if you look at the book, Investing Legacy, by going to investinglegacy.com, one of the things is that one of the founding fathers of sports ownership is in chapter 5. And in that chapter, he talked about how his father was able to do that because he was a very good equity investor, not a merchant developer, not a flipper, not an operator. He was a very good, just basically putting the money down. And that's exactly what we're going to be talking about. And if you have any sort of, not just money yourself, but if you have any sort of influence on investors who you might be able to raise money from for your own account, then this is something you definitely want to attend. And the networking is going to be very rich too, as well. Yeah,
I would think that'd be a really, really high level event. So, so Tuesday, June 13th, Wednesday, June 14th in Miami, which probably pretty hot by that time of year, but it still sounds delightful sitting here in snowy Salt Lake City, for sure. Sal, anything else? Any
No, I would say always make sure that you're out there building relationships, because it's the relationships that are going to feed you for life.
Yep.
Really. And that's really what it is. And if you really are serious about this, you need to get into salesmanship and be personable and go out there. Nobody's going to write a check to someone without them spending their time with you first. And if they're interested in the masterclass, they can go to salvatorebuscemi.com/masterclass. I believe the registration's open. Yes, salvatorebuscemi.com/masterclass. And there's a link there for you to join. And, by all means, I'd love to have you guys onboarded onto our multifamily office platform so you can see our practice, that we walk our talk.
Yep. Guys, this is an episode that you want to take some action after, like immediately after. You want to download this book if you haven't already. You want to go back and listen to this again and take notes. Make sure you understand all 20 of those steps, and connect with Sal. Look him up. You got a great social media presence, LinkedIn.
Thank you so much. Thank you.
Yeah.
It's been a pleasure and a privilege being on this. And remember to build the relationships. Never forget the second rule of real estate, which is always be raising capital.
Yeah.
And download the book and print it out and highlight it and tell me what you think about it.
Guys, is like I said before, the most challenging part of this business is the capital side. I don't care what anybody says, and getting the deals, all that stuff. Yeah, there's hard work in every aspect of this, but the capital side, like Sal said, this is a lifelong relational game that you're playing. It's not transactional at all. So, and if you think about it, that really takes the pressure off, right? Like all you're doing is connecting with people, and that's what we do naturally anyway. So just go out and do it, and add value. Yeah,
absolutely.
Sal, thank you so much. Super grateful to you.
Thank you.
What a home run this was. So, listeners, I hope you thought the same thing. And we love your ratings and reviews if you do feel so led. But you're doing good stuff by listening to these episodes. This was as rich as it gets, in my opinion. So hopefully you just got a ton out of it. Do those action steps that we talked about. And go to this, if you really want to really, really make stuff happen in your world, go to this masterclass in Miami in June. You want to step things up, that'll step things up for you. So on that, thank you, listeners. Thank you, Sal.
Thank you.
See you all on the next episode of the Apartment Gurus. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.